Hi and welcome to Swissquote's Daily Market Talk. It's Thursday, October 10th. Investors are holding their breath before the US CPI data that's due today, and that will probably show that headline inflation in the US eased last month. But core inflation may show some resistance to slow below the 3% mark, and any disillusion there could eventually give support to the renaissance US dollar rally and weigh on major US indices that are near their all-time high levels right now. And so we continue to count 44. The S&P 500 hit its 44th record this year yesterday after flirting with the 5,800 level for the very first time in history. Nasdaq 100 also gained and closed yesterday's trading session above the 22,000 mark. The Dow Jones Industrial Index advanced 1% to almost a fresh all-time high level as well, while investors were somehow less enthusiastic regarding the small cap stocks. So the Russell 2000 index lagged behind its major peers but was up by 0.26% yesterday as well. Over here in Europe, the STOXX 600 index was better bit yesterday, while the FTSE 100 index in the UK recovered a part of the previous day's China-related losses. Then in China, the bleeding in the CSI 300 index stopped today, and the index jumped close to 3% in the Asian session, and that was basically on details about the liquidity tool that institutional investors could use to buy shares, and that was announced previously, but the details came just today, and on hope that the new government briefing on fiscal policy due Saturday in China will bring the kind of stimulus measures that investors are happy with. And Xi Jinping's government probably understood very well this week, or again this week, that anything less than absolutely mind-blowing wouldn't do, as we are now celebrating the fourth year of the crackdown on the country's big technology companies. In the sense, while Alibaba was trading near $300 a share in October 2020, and now hardly above the $100 per share level. So China has a long ways to go to bring investors back on board, and it must simply deliver to restore appetite. Confidence is yet another story. But anyway, market sentiments today isn't that bad. Copper and iron ore futures are up, and US crude is better a bit as well. The barrel of US crude tipped a toe below the 50-day moving average yesterday and below a major Fibonacci support, but rapidly rebounded on the back of ongoing geopolitical tensions and despite a 5.8 million barrel build in US inventories last week. Now, obviously, the geopolitical risks in the Middle East remain tilted to the upside, and the excitement that China could, maybe announce a nice and a solid fiscal stimulus package this weekend will likely throw a floor under any weakness that we might see in oil prices into this weekend. So support could eventually be found near the $72.85 to $73 per barrel range. That matches the major 38.2% Fibonacci retracement on July to September decline, and also the 50-day moving average. Elsewhere, US futures are flat at the time I'm talking here. The Federal Reserve minutes that were released yesterday show that there has been at least some pushback to the Federal Reserve's 50 basis point cut last month, as some Fed members thought that it would be maybe more reasonable and somehow more cautious to start with a 25 basis point cut, but obviously most prefer to rush to the exit, a possibly premature decision that could eventually justify a month of pause from the Federal Reserve to rectify the overly dovish move. Maybe. We will see that. But the probability of a no rate cut from the Fed in November meeting is gently creeping in. That probability now stands at 15% this morning ahead of the upcoming US CPI data from the US, and has further room to mature in investors' minds if the economic data continues to defy the slowdown expectations in the US. And even though the Federal Reserve members shifted their attention from inflation to jobs market, inflation is still important. And as some Federal Reserve members said, like Philip Jefferson, for example, the risks are probably roughly in balance right now between inflation and jobs. So that means that any uptick that we might see in US inflation could reshuffle the Federal Reserve expectations and, well, the market pricing attached to these expectations. Now, note that the headline inflation in the US is expected to have eased from 2.5% to 2.3% in September, but the core inflation is expected to have remained sticky above the 3% mark. And remember, wages also grew at 4% last month, so meaning that the Federal Reserve is getting closer to its destination in terms of inflation, but it is not there just yet. And the last mile could and would, in theory, require an undesired weakness in the US jobs market that the Fed doesn't want, but that's just needed to stabilize inflation near the 2% level. I mean, that's the good old Phillips curve that says that there is this unfortunate negative relationship between unemployment and inflation. So when one rises, the other falls, and one falls, the other rises. And well, you can have both falling, both inflation and unemployment falling in the perfect world, which is the Goldilocks scenario that we are talking about. But it's like to have your cake and eat it too, and it is just not a given. But anyway, the reasoning goes as usual regarding the data and the market reaction. A data in line with the market expectations, or ideally softer than expected, will I'll keep the expectation of another interest rate cut from the Federal Reserve in the November meeting alive. I think we will unlikely see a data soft enough to boost the expectation of another 50 basis point cut in November, because I think that expectation is rather boosted by the weakness of the economic and jobs data, and the latest jobs data was just too strong to hold on to it. And note that Atlanta Fed's GDP is now pointing at a growth rate of more than 3% in the US in the third quarter, and that's obviously, you would agree with me, not the kind of number that would back another 50 basis cut from the Fed next month. But who knows? They really look like they want to keep this market rally going in the US. But anyway, I was saying that a sufficiently soft inflation figure from the US today will probably keep the expectation of another rate cut, probably a 25 basis point cut, on the table for November. However, a stronger than expected read today could further revive the worries that the Federal Reserve may have declared victory over its inflation battle prematurely, and eventually boost the bets that it would have to wait in November to rectify its jumbo rate cut decision of last month. We will see how the things go, but what's easier with inflation, unlike with the jobs data, is that a stronger than expected inflation number is no good news for no one. So if today's inflation data from the US isn't soft enough, we could see the US yields and the US dollar extend their recent gains, and the major US indices will maybe refuse to renew record. So the US dollar index pushed above its major 38.2% Fibonacci resistance level on a summer decline yesterday. So that's near 102.50 yesterday, and is waiting the inflation print, having stepped into the medium-term bullish consolidation zone. Likewise, the euro-dollar sank below its own major 38.2% Fibonacci retracement level on summer rebound, and is now consolidating in the medium-term bearish consolidation zone. The dollar-yen, on the other hand, also traded past its own major 38.2% Fibonacci resistance near 148.10 level last Friday, and is preparing to test the 150 offers to the upside. So if inflation data is not good enough today, the dollar bulls are already in a mood to push the US dollar rally further. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.